If you've been watching the silver market, you've probably noticed something that doesn't quite add up. We're in the sixth consecutive year of a global silver deficit. That means for 6 years straight, the world has been consuming more silver than it produces. Basic economics tells us that when demand exceeds supply, prices should go up, and they have. Silver is currently trading around $83 per ounce as of February 12th, 2026, and over the past year it's up a staggering 162%. But here's what's puzzling people. If we've had 6 years of deficits, why isn't silver at $200? Why did we just see a 50% crash from the all-time high of over $100 that we hit in late January? And most importantly, what does this persistent deficit really mean for where prices are headed next? Today we're going to dive deep into the silver deficit, understand why it matters, why prices behave the way they do despite these shortages, and what this means for your investment decisions going forward. Let's start with the numbers because they're absolutely critical to understanding what's happening. According to the Silver Institute, the silver market is expected to face a deficit of 67 million ounces in 2026. Now, 67 million ounces might not mean much to you as a raw number. So let me put it in perspective. Global silver mine production is roughly 800 million ounces per year, and total supply, including recycling, is around 1 billion ounces. So we're talking about a deficit that represents nearly 7% of total supply. That's not a trivial shortage. That's a significant imbalance between what the world needs and what the world is producing. But here's where it gets really interesting. This isn't a one-year phenomenon. This is the 6th year in a row. Let me repeat that because it's crucial. 6 consecutive years of deficits. If you add up the cumulative deficit over these 6 years, we're talking about hundreds of millions of ounces of silver that have been drawn down from above-ground stocks, inventories, and existing supplies. In any normal market, you'd expect this kind of persistent shortage to send prices absolutely parabolic. So why hasn't that happened in a more dramatic way, and why do we still see such extreme volatility? The answer lies in understanding how the silver market actually works, and it's more complex than most people realize. Silver is unique among commodities because it sits at the intersection of 3 different markets. It's an industrial metal, it's a precious metal for investment, and it's a monetary metal with thousands of years of history as currency. Each of these roles creates different demand dynamics, and they don't always move in the same direction at the same time. Let's talk about industrial demand first, because this is where the deficit story really begins. Industrial fabrication of silver is forecast at around 650 million ounces for 2026. This represents about 2/3 of total demand, and it's driven by silver's unique properties. Silver is the best conductor of electricity and heat of any metal. It's highly reflective, it's antibacterial, and it's incredibly malleable. These properties make it absolutely essential for modern technology. We're talking about solar panels, electric vehicles, smartphones, computers, LED lighting, medical devices, water purification systems, and increasingly, the infrastructure that powers artificial intelligence and data centers. The demand growth in technology has been absolutely explosive. Since the year 2000, IT power capacity demand has increased by 5,252%. Think about that for a moment. We're using over 50 times more IT power capacity than we were just over 2 decades ago, and silver is embedded throughout this infrastructure. Every server, every data center, every advanced chip uses silver. As we push toward 5G networks, autonomous vehicles, smart cities, and AI-powered everything, the industrial demand for silver isn't just growing, it's accelerating. Now here's a really important point about industrial demand. Companies that use silver in manufacturing don't really have a choice about whether to buy it or not. If you're making solar panels or circuit boards, you need silver. You can't just decide to skip it because the price went up. Sure, manufacturers work on efficiency improvements and substitution where possible, and we're seeing that in the solar industry, where companies are using slightly less silver per panel through thrifting techniques. In fact, the Silver Institute forecasts a 2% decline in overall industrial fabrication in 2026, primarily due to these photovoltaic sector efficiencies. But even with those improvements, industrial demand remains enormous and relatively price inelastic in the short term. This creates a floor under silver demand that didn't exist decades ago. In the 1980s and 90s, silver was primarily used for photography, jewelry, and silverware. Those uses were much more price sensitive and easier to substitute. Today's industrial applications are different. They're embedded in essential technologies that define modern life. This structural shift in demand is one of the key reasons why many analysts believe we're in a long-term bull market for silver, despite the short-term volatility. Now let's talk about the supply side, because this is where the deficit problem becomes really apparent. Global silver mine production has been essentially flat for years. We're not discovering major new silver deposits at the rate we did in previous decades, and it takes years and enormous capital to bring a new mine into production. Most silver, about 70%, is actually produced as a byproduct of mining other metals like copper, lead, and zinc. This means silver supply is somewhat constrained by the economics of these other metals. You can't just turn on more silver production when prices are high because silver isn't usually the primary economic driver for mining operations. On top of limited mine production, recycling has also been under pressure. Silver recycling, which typically comes from industrial scrap, jewelry, and old electronics, tends to be price sensitive. When prices are very high, recycling increases. When prices fall, recycling decreases because it becomes less economical. The recent volatility we've seen, with silver crashing 50% from its January highs, could actually discourage some recycling activity in the short term, which would tighten supply even further. So we have industrial demand that's large and relatively inflexible, mine supply that's constrained and can't respond quickly to price signals, and recycling that's variable but limited. This is the recipe for persistent deficits. The market has been drawing down above-ground inventories to make up the difference, but those inventories aren't infinite. At some point, if deficits continue, we'll hit a wall where there simply isn't enough readily available silver to meet demand without significantly higher prices. But here's where the story gets complicated, and this is why silver prices don't just go straight up despite these deficits. The silver market is heavily influenced by the paper market, meaning futures contracts, options, and exchange-traded products. The physical market, where actual bars and coins change hands, is relatively small compared to the paper market, where massive amounts of silver are traded every day without any physical metal moving at all. These paper contracts allow for enormous leverage, meaning traders can control large positions with relatively small amounts of capital. When the Chicago Mercantile Exchange increased margin requirements from 11% to 15% on February 11th, it triggered a massive liquidation in the paper market. Leveraged speculators who had been riding the rally up to over $100 per ounce suddenly had to either post more collateral or close their positions. Most chose to close, and that selling pressure overwhelmed the market, causing the 50% crash we just witnessed. This happened despite the fact that the physical market remained tight, with dealers reporting strong demand and elevated premiums on coins and bars. This disconnect between paper and physical is one of the most important dynamics in silver. In the short term, the paper market dominates price discovery. Sentiment, speculation, technical trading, and leverage all drive rapid price movements that may have little to do with the underlying supply-demand fundamentals. But in the long term, physical reality matters. You can't print physical silver the way you can create paper contracts. Eventually, if deficits persist and inventories decline, the physical constraints will assert themselves in the price. There's another factor that explains why silver hasn't gone to the moon despite 6 years of deficits, and that's above-ground stockpiles. Silver has been mined and used by humans for thousands of years, and there are enormous amounts of silver sitting in vaults, warehouses, coin collections, jewelry boxes, and forgotten storage units around the world. Estimates of above-ground silver stocks vary widely, but we're talking about billions of ounces. When prices rise significantly, some of this silver comes back to market through recycling and selling. This acts as a buffer that prevents prices from spiking as dramatically as they might if we were dealing with a commodity that had no stockpiles. However, and this is crucial, not all above-ground silver is equally available. Silver locked up in jewelry, silverware, and small coin collections has a very high threshold before it comes back to market. People don't typically melt down grandma's silver set unless prices are extraordinarily high. The silver that's most readily available is in industrial inventories, ETF vaults, and bullion dealer stocks. These inventories have been declining, and they're the ones that matter most for meeting the deficit. Let's talk about investment demand, because this is the wild card in the silver equation. Industrial demand is relatively steady and predictable. Supply is constrained but fairly consistent. Investment demand is volatile and driven by sentiment, macroeconomic conditions, and financial market dynamics. In early 2026, investment demand surged due to elevated geopolitical tensions, concerns about Federal Reserve independence, and broader worries about currency debasement and financial system stability. Silver, along with gold, benefited enormously as investors sought safe haven assets. When investment demand is strong, it can push prices much higher than industrial fundamentals alone would justify. When investment demand wanes, prices can fall, even if the industrial deficit persists. This is exactly what we saw with the recent crash. Leveraged speculators and momentum investors rushed for the exits, overwhelming the steady industrial demand that continues regardless of price volatility. But here's the thing about investment demand. It tends to follow trends. If silver can stabilize and resume its upward trajectory, investment money will likely flow back in, potentially pushing prices even higher than the January highs. So what does all this mean for where silver prices are headed next? Let's think through the scenarios. The fundamental deficit hasn't disappeared. 67 million ounces of shortage in 2026 is real, and if industrial demand continues to grow while supply remains constrained, this deficit could persist or even widen in future years. The structural drivers of demand, particularly from green energy and technology sectors, aren't going away. Solar panel installations continue to grow globally, despite efficiency improvements. Electric vehicle adoption is accelerating. Data centers and AI infrastructure are expanding rapidly. All of this requires silver. On the supply side, there are no easy solutions. Bringing new mines online takes 5 to 10 years from discovery to production. Existing mines are dealing with declining ore grades and rising costs. The price spike to over $100 in January might incentivize some new exploration and development, but those projects won't add meaningful supply for years. In the near term, supply is essentially fixed, which means any increase in demand has to be met by drawing down inventories or through higher prices that encourage recycling and discourage marginal uses. The current price around $83 is interesting from a technical and fundamental perspective. We're testing a critical support level at the 38.2% Fibonacci retracement around 81.85. If this level holds, it suggests that buyers are viewing current prices as attractive relative to the fundamentals. If it breaks, we could see another leg down toward $70 or $75 as the market searches for a level where physical demand overwhelms paper market selling. From a fundamental valuation standpoint, the question is, what price level balances the market given the persistent deficit? If we continue to see 60 to 70 million ounce deficits year after year, inventories will continue to decline. At some point, industrial users will start to worry about supply security and may be willing to pay higher prices to secure material. This kind of panic buying from industrial consumers could be a major catalyst for the next leg up in silver prices. There's also the macroeconomic backdrop to consider. Central banks around the world are diversifying away from dollar-dominated reserves. Inflation concerns remain despite central bank efforts. Government debt levels are at historic highs. Currency debasement fears are widespread. These are exactly the conditions that historically drive investors toward precious metals. If we see another wave of financial market stress or geopolitical tension, silver could benefit enormously from safe haven flows. Remember, even after the 50% crash, silver is still up 162% over the past year, which tells you the long-term trend has been powerful. Some analysts are projecting silver could reach $175 or higher by the end of 2026. That might sound aggressive after what we just went through, but consider this. If the deficit continues, if investment demand returns, and if we see any kind of supply disruption or industrial panic buying, prices could move much faster than people expect. Silver is a relatively small market compared to gold or major commodities like oil and copper. It doesn't take enormous amounts of capital to move the price significantly when conditions are right. On the flip side, we need to acknowledge the risks. The Chinese Lunar New Year from February 16th to 23rd could create near-term liquidity issues and volatility. If industrial demand disappoints due to global economic weakness, the deficit could narrow. If paper market deleveraging continues, we could see more downside before the physical fundamentals reassert themselves. The path forward is unlikely to be smooth, and anyone invested in silver needs to be prepared for continued volatility. Here's my bottom line on the 6th year of silver deficit. The shortage is real, it's significant, and it's not going away anytime soon. The fundamental drivers of demand are structural and long-term. Supply is constrained and can't respond quickly. These conditions strongly suggest higher prices over time. However, the path to those higher prices will be volatile because the paper market creates short-term noise that can overwhelm physical fundamentals. The recent crash was primarily a function of leverage and speculation, not a change in the underlying supply-demand story. For patient investors who can handle volatility, the deficit story remains compelling. For traders, the key is watching how price behaves around critical support and resistance levels and being aware that silver can move violently in both directions. The deficit is telling us something important about the supply-demand balance, and while markets can stay irrational longer than you might expect, physical reality eventually wins out. That's the bet long-term silver bulls are making. And with 6 years of deficits behind us and likely more ahead, that bet looks increasingly rational despite the wild ride we've been on.